Hi, we continue with our discussion of Unit 3 in Financial Reporting and Analysis and continue with income statements. Now, we've already seen broadly what's the broad structure of an income statement and how does the revenue and cost structure come into being. Now, the more important part that will come to us is in terms of actually figuring out how the revenues and expenses get recognized, right? So in this particular video, we're going to talk about the revenue recognition methods as to how do you recognize whether a sale has happened or not happened, and what is the implication of all this recognition into the statement, right? We'll take a few examples and understand that, and then at a later point, we're going to kind of try and construe that in terms of individual company and their income statements. So we'll just quickly recap when exactly do we account for sales and expenses. When a business basically sells goods to the customer, essentially, the sale is booked. Once the ownership has transferred the hands from a vendor to a business, that's when the expense is booked. And ownership has been transferred from the business to the customer, that's when the sale is booked, right? So broadly, it's when ownership gets transferred, but in some cases, that may or may not be so easy to figure out, right? Ownership transfer, while is the easiest way to figure out when there is a good or service being offered, in certain cases, that may or may not be so easy to kind of calculate, right? So, for example, in services businesses, how do you do it? There are multiple other cases where exactly ownership transfer may not be so easy to kind of figure out, right? Now, revenue recognition can occur independently of any kind of cash movements, right? So the cash flow has got nothing to do with the revenue recognition. The sale of goods and services can happen on credit, basically, where you will find a receivable essentially that will come in, and receipt of cash in advance of providing of goods and services can also happen. So basically the cash could come in at a different point. The revenue will get recognized based on certain principles only specific to the revenue recognition. Now, a fundamental principle of accrual accounting is that revenue is recognized in the period in which it is earned. When we say recognized, by recognized we mean reported in the income statement. So when is it earned is the question for us. Once we know that it has been earned in that period, then it has to be recognized in the income statement in that particular period itself, right? Now, let's understand how do you define whether the revenue has been earned in that period, right? So sale of goods and services rendered, sale of services basically. So in the case of goods, when risk and reward of ownership is transferred, so as soon as the ownership is kind of transferred, that's when it is assumed. When we say risk and reward, so for example, there is a seller, there is a seller who is selling goods to a buyer, and there is a truck that is being transferred, a container of goods is being transferred, right? The moment the risk and reward of ownership is transferred, so it could be that, let's say I'm selling it from Mumbai and someone is buying it in Chennai. So essentially, depending on what is the contract, it's possible that when the truck leaves my factory, the sale and reward of ownership, the risk is transferred. Whose ownership is there is a part of the sale contract. So it's possible that the buyer says that till the time you deliver it to my factory, it is your risk. In which case, it will be considered till the time it reaches here. If I am able to kind of get a term saying that, that transportation is not my headache, so I can sell it from my factory, you get it picked up and you take it, then the sale is kind of considered here. So there's a slight timing difference that can occur, but basically the moment the risk and reward of ownership is transferred, that's considered a sale of goods. Or when there's no continuing control or management of the goods sold, when I have given the goods out of my building and someone else has management of it, it's the transportation could have been outsourced. Revenue can be reliably measured at that point of time. There is a probable flow of economic benefits. So I was giving the revenue and I get the cash at this point of time, or the cost can be reliably measured. In any of these cases, the sale of goods is considered done, right? In the case of services, you consider the revenue as earned if the amount of revenue can be reliably measured, if there is a probable flow of economic benefits, if the stage of completion can be measured, or if the cost incurred and cost of completion can be reliably measured. I'll take an example and explain this in terms of how do you look at cost incurred and cost of completion, or the stage of completion here, as well as the stage of completion in the context of sale of goods, right? Now, there are specific situations where revenue recognition will become tricky. So we will look at each of these situations. The first one is a long-term contract. Let's say L&T building an airport, right? Now L&T building an airport is going to probably happen over 3 to 4 years. So that's a long-term contract. Now if they're building the airport and the government has said they will pay L&T 12,000 crore for it over 3 years, what is the revenue recognition in the first year? Remember, cash flow may have no bearing here. So that's one part. Then installment sales. So houses, for example, are sold or installments, or cars are sold or installment, or some installment sale happen. Typically, an installment will have the sale amount, and there will be an interest component because there is an installment that is happening there, right? So how do you look at that? Barter transaction is where no cash is exchanged. Basically, people are exchanging goods for another good, or services for goods, or services for services, essentially, right? So how do you recognize the revenue in those contexts? That becomes the important crux of figuring out these three situations. So let's understand each one of these. Long-term contracts are contracts spanning over a number of accounting periods, as we looked at the example of L&T. Here, percentage completion method is used, and the cost, how much cost is undertaken, decides the revenue booking, right? So take an example of the L&T airport. Let's assume that we are saying that the airport is going to be giving a revenue of 12,000 crore, and L&T is going to take a cost of 10,000 crore. So that's the revenue, and this is the cost, total cost over 3 years. That's the discussion that we have, right? Now at the end of year 1, 2, and 3, how do you book the revenues, right? Now there's no real way of figuring out how much revenue should have happened in, because the government might have said, I'll give you the entire amount at the end of 3 years, right? Once you give me the airport, I'll give you the money. So how much revenue should L&T book in the first year? One answer is when they get cash, they should only book it there, but that's incorrect because we're looking at accrual accounting here. The second answer is they divide it equally into 3 years, but then that is again going to penalize because a lot of these things might get completed in the second year, but testing itself might take the third year, right? So they will unnecessarily get penalized because of that. So what is used is the percentage completion method, and under this you figure out how much cost has been already taken. Let's assume 3,000 crore worth of cost is already taken here, right? So what is that as a percentage of total cost? 30%. So you're assuming that the project is 30% complete. If the project is 30% complete, you're going to assume that the revenue is also 30% of the total revenue number. If in the second year you take another 5,000 crore of cost, that's 50% more done. So another revenue would be 6,000 crore. And then obviously in the third year, whatever is the remaining will come. So in longer term contracts, you will basically build this in terms of how much cost has been undertaken. That leaves it open to some sort of subjectivity, because a company can over report costs or inflate costs in order to over report revenue. That discussion will come at a later point where we will look at some checks and balances about how companies try and do that. But in general, that's the accounting method where we are trying to figure out how much of the cost has been undertaken, and based on that we are trying to arrive at a number as to what is going to be the percentage of revenue that the firm has basically accrued in that period, right? So that's basically the structure of revenue in terms of long-term contracts. Now, if there is an installment sale where payments are in installment, so there is going to be a sale value and there is going to be a interest component, right? So what you do is, let's say installments are going to come in the form of 100 in the first year, 100 in the second year, and 100 in the third year. So you figure out how much of this 100 is the sale value plus interest, sale value plus interest, sale value plus interest, right? You look at all the sale value components and you find the present value of the sale value. Sale value being the amount. So if you're selling a car, for example, for 3 lakhs, maybe 1 lakh comes in the first year, 2 lakh comes in the second year, 3 lakh comes in the third year, third lakh, right? So 1, 2, and 3. So we are saying that the car's cost maybe is 2.7. You're going to give 1 lakh right now, 1 lakh next year, and 1 lakh the year after that, right? So the cost is 2.7, but you're paying 30,000 of interest. That gives you 3 lakhs, right? Now in the first year, this is only principal because there is obviously no cost. So you're giving this money right away. Second year, you have, let's argument's sake, we are saying that the interest component in the second year is 85 plus 15, 0.85 and 0.15, right? And again here is 0.85 plus 0.15. So how are you going to book the revenue? Present value of 1, 0.85 and 0.85 is going to be booked now. And the 0.15 and 0.15 is going to be booked in the second year and third year because that interest is coming there. So interest payments are booked in the year when they are happening. Present value of the sale value is booked now. Let's revisit this to make this clear. So what we are saying is that let's say there is a car that is worth 2.7 lakhs and it is being sold for 3 lakhs, right? So how much is the interest component? 30,000. That's the interest component, right? Let's say the first year is 1 lakh, the second year is 1 lakh, the third year is 1 lakh, right? And this does not contain EMI. This contains 0.85 plus 0.15. This contains 0.85 plus 0.15. Let's assume this is the structure. So the today's sale now or this year, what you're going to book is the present value of only the sale component, which is 1, 0.85 and 0.85. I'm taking a simple example here, right? So 1, 0.85 and 0.85. I'm not writing them as 2.7 because they're happening at different times. So 1 is happening today, 0.85 is happening after a year, 0.85 is happening after another year, right? So to find the present value of these three. The present value can basically be found using, so 0.85 next year is not the same as 0.85 today, right? So it's probably worth lesser. So you'll find and try and find what is the current value of that, and discussion on present value will come at a later stage. We'll discuss that in more detail. The 0.15 will happen in that subsequent year. That's the interest component. So what is happening in year 1 and what's happening in year 2 will get accounted there when it gets done, right? That's how it comes as installment sales. Don't worry about this in case it is not very clear at this point of time, because it'll obviously get repeated as we go along. Then there are barter transactions where two parties exchange goods without or services without cash payment. Under IFRS, International Financial Reporting Standards, revenue from barter transactions are basically assumed to be the fair value of similar revenues, similar non-barter transaction, right? So let's say I exchange one car with uh, 3 bikes, right? Let's say I do this. I exchange one car with 3 bikes. So effectively, the revenue will be what is the fair value of one car or what is the fair value with 3 bikes, right? That's what is considered as the revenue number in that context. So that's what we'll book. That's what is the number we will put in our income statement. Next concept that comes is something called as gross and net revenue reporting. Now consider the case of Flipkart. Flipkart is sort of a trading company. It's a retail company. Let's say it sells a book for 300 while the cost of the book is 280. So what should be the revenue from them for them, right? They sell a book worth 300. The cost of it is 280. Now technically Flipkart is just trading. They never really produced anything, right? So I buy a book from someone at 280 and give it to you for 300. Should my sales be 20 because all my costs will be taken out from this 20, or should my sales be 300? So under the gross reporting of revenue, sales would be 300, cost of goods sold would be 280, and then you get to the value of 20, and then you remove all your further costs from that 20 to get to the net profit. Under net reporting, it's only trading the book. So sales is 20 and you remove your costs, that comes to the net profit. In both the cases, remember the net profit is going to be the same. These costs are my costs or Flipkart's cost, which is uh, salary of the delivery boy or electricity of the warehouse, etc. that is there, right? Net profit is the same, but the revenue number is bigger in gross and smaller in net, right? Now, typically companies use the gross method, but that's just for understanding as to what is gross and what is net. That's an important area for us to discuss, right? So that basically brings us to an end of this particular section where we discussed about revenue recognition. Quick couple of questions here. Explain the concept of revenue recognition from a long-term project perspective, and what is the difference between gross and net revenue reporting?